name is Michael Lessa. I represent the University of Michigan Dearborn. Really the most important lesson that I learned in the research challenge is the ability to apply several evaluation techniques to arrive at a reasonable valuation. The biggest challenge was a combination of things, really. It was mainly there was quite a bit of a learning curve, obviously, and then there was a substantial amount of research involved. We've got well over 500 hours of research and preparation for this, so it was exciting. Absolutely. There were really the research challenge does a fantastic job of preparing our analysts for the real world. It really forces you to go well beyond the classroom experience, and you really have to apply not just what you learned in the classroom. It forces you to go beyond that learning. I will definitely place equity research high on my list for consideration following the CFA Research Challenge, because while it was very difficult, it was a lot of fun, and I learned a great deal, and I will definitely be promoting the event for our future analysts at the university. Good morning. We represent the University of Michigan Dearborn. I'd like to introduce to you our analysts. I'm Michael Lessa. This is Paige Patton, Shane Kennedy, and Jesus Madrigal. I'll start off by introducing the Kellogg Company, which is currently the global leader in cereal production, and now the second largest producer of snacks with the acquisition of Pringles. That acquisition added 139 new snacks distribution opportunities and synergies, and the company is also placed in the top 5 in the food processing category for innovation. Next, we've issued a hold recommendation on Kellogg with a year-end target price of $64.75, or a 6.02% upside gain. This was primarily driven by the expectation of sluggish earnings growth in the already saturated U.S. cereal category, which continues to show little room for expansion. In addition, the company's propensity toward high debt financing results in uneven contributions to EPS growth. On top of that, our analysis shows that although Project K will provide long-term cost reductions and benefits, those benefits will not likely come soon enough to benefit the company's stock price much in the 2014 year. Paige will now provide a more detailed description of the business and its competitive positioning.
Thanks, Mike. The food manufacturing industry is one of many opportunities but also challenges. Consumers have very little brand loyalty when it comes to price sensitivity, and there are high barriers to entry when it comes to food production. As well, grocery stores, which are the largest distributors, have major bargaining power when it comes to prices and quantities. With a high Herfindahl-Hirschman index of 118.7, along with a cereal penetration rate of 90% in the U.S., there's large competition between firms. Some of Kellogg's competitors include PepsiCo, General Mills, Mondelez, and Conagra. We feel that Kellogg is fairly middle of the pack when it comes to market capitalization and sales. We feel this is because they are laggards on a global scale despite a large brand portfolio, including U.S. favorites like Keebler and Cheez-Its, a small portion of which are available outside of the U.S. Of those products available outside of North America, the recently acquired Pringles is the only snack-focused product. Due to this U.S. focus, Kellogg has had difficulty maintaining growth as the U.S. markets offer small gains. However, they have recently committed to Project K, a new initiative to reduce expenses, which should help inflate net income in a low-growth environment. They have also acquired Pringles, which allows for new distribution opportunities. The deal has made Kellogg the second largest snack producer globally. We also believe that this will allow them to produce other snack products globally as well. With 32% of sales in emerging markets, this will give them a future source of growth. I will now turn it over to Shane to talk about the financial analysis.
Kellogg displays very moderate earnings potential relative to its peers. We see this in its EPS and its PE ratio. For our EPS, we expect a mean year-over-year growth rate of 9.79%, aided by revenue growth of 2.5%. For our PE ratio, we expect a 2013 value of 16.18 and a 2014 value of 15.9. Now, this is based off of Kellogg's 2013 year-end stock price, our 2014 target price, and our own forecast of EPS. Kellogg displays moderate margins. We expect modest mean year-over-year growth rate of 0.74% for gross margin and a higher growth rate of 6.52% for operating profit margin. Kellogg has a very high ROE aided by a high equity multiplier. However, we expect the equity multiplier to decline in the coming years and for that to drive a decline in ROE. Now, Kellogg displays an excellent ability to manage its cash flow relative to its peers. It has a very low cash conversion cycle, aided primarily by a low receivables conversion period, that is an excellent ability to collect on accounts receivable, and a high payables conversion period, that is very favorable terms with short-term creditors. It also does a decent job managing its overall liquidity, as it held a current ratio of 1.02 for 2012, and we expect this to grow at a mean year-over-year rate of 8.44%. Now, Kellogg held a debt-equity ratio of 4.26 per its most recent 10Q filing, and as you can imagine, interest rate payments on such a high-leverage company can be pretty substantial. So in order to offset this, it engages in a practice of interest rate swaps to reduce its effective interest rates on both USD and euro-denominated debt. And per its most recent 10Q filing, their effective interest rates were lower than their 2012 year values. I'm going to hand it off to Michael so he can speak more on our valuation.
For our valuation, we used a combination of multipliers, DDM, and DCF. For our multipliers valuation, we used a combination of an equal weighting of price earnings and enterprise value EBITDA because we wanted to create a balanced view of the company's ability to generate cash and also take into account its market performance. And that method yielded us with a price of $69.87. Now, a key highlight of our DDM includes a stable dividend payout over the last 5 years despite harsh industry environment during recessionary years. And we computed that growth rate with a weighted average to give us a 5.13% dividend growth rate over the past 5 years. And we subsequently computed the DDM price of $57.66. Now for our DCF, we computed the equity value indirectly using free cash flow to the firm to allow for a more stable growth rate given Kellogg's heavy use of debt. Now, that was primarily driven by lower year-over-year revenue growth along with SG&A as a percent of sales, and that was also followed up by an increasing weighted average cost of capital. Now, we're expecting SG&A as a percent of sales to increase incrementally through the life of Project K with Project K charges as well as higher ad spend. Now, we also included a dynamic WACC figure to account for the expectation of increasing cost of debt with in view of the changing interest rate environment. This method yielded us a price of $65.73. Now, we combined these models using a weighting based on Kellogg's investor preferences, and that provided us with a combined year-end target price for 2014 of $64.75, or a 6.02% holding period return. I'll now hand it off to Jesus, who's going to consider the risk measures.
We view Kellogg's overall risk as low, but to highlight some of the relevant risks, we start in the operational area, where Project K could be a concern. The project involves significant organizational and infrastructure changes, and a delay or failure to realize benefits will have a significant impact on earnings. Product recalls have also been an issue recently, with 3 recalls occurring in the past 4 years, one affecting year-end diluted EPS by 9 cents and another by 5 cents. Also, private label competitors offer inferior substitutes, but force Kellogg and its other competitors to resort to promotional sales, which for Kellogg were 40% in 2012. In the risk area, Kellogg's highly leveraged position and recent rate swaps expose them to interest rate volatility. which is especially a concern due to recent tapering by the Fed. Its largest commodity exposures are natural gas and diesel fuel, both of which have price arrangements through long-term supplier contracts. Now, ingredient prices are expected to fall, but a portion of requirements are covered by futures and options. Kellogg operates in 6 national currencies, which exposes them to transaction and translation risks. However, these positions are hedged by forwards, options, and currency swaps. For macroeconomic risk, as we compare Kellogg's growth to that of the U.S. GDP and European Union GDP, we see that during times of economic growth, Kellogg's growth was roughly double that of the U.S. and the European Union. And during the financial crisis, the growth gap was roughly proportional. We believe this shows Kellogg had a moderate ability to weather the storm of financial crisis. And also, although the European economy is currently struggling, Kellogg's, through 3 quarters of this year, Kellogg had internal net sales growth of 3%. For risk to our valuation, we ran a Monte Carlo scenario analysis in which we varied the 4 most sensitive factors of our DCF valuation. This gave us a mean target price of $67.79. We believe this compares well to our DCF target price. It also gave us a 40% probability of a hold. We believe these results are confirming to our target price and subsequent recommendation. So in conclusion, a target growth rate of 6.02% combined with overall growth and future margin improvements from Project K, as well as future potential growth from product innovation, lead us to a hold recommendation on Kellogg Company. We'd like to thank the judges for volunteering their time and the CFA Society of West Michigan for sponsoring the event. We will now field any questions.
On your risk analysis, you talk about market risk. What about risk to consumers? Recently, we've seen a situation where, I don't know, past 5 or 6 years, we've got pretty much zero growth in real consumer net incomes, toughness on the consumer market where consumers are looking to spend less. How would that impact Kellogg's when you're talking about branded products that have natural price premium versus, substitute products, private labels, that sort of thing?
Of course, this obviously affects their resortment to promotional sales, and recent reports do show consumer confidence increasing. So we, roughly optimistically view on that point.
And we would like to add that with 36% of consumers looking for snack products under $1, for example, that Kellogg has addressed this with making smaller product sizes. For example, their 100-calorie packs, basically addressing that need by reducing product volume.
I have a couple questions just regarding, you mentioned that you're concerned about the amount of leverage in the company. Can you describe what the debt structure is like?
Well, if you take a look at our appendix, actually. You'll see that Kellogg's debt structure, it holds a lot of long-term liabilities. What Kellogg's very fond of doing is it's very fond of laden itself with debt when it's taking on either major new initiatives, whether that's like Project K, or even just major acquisitions, things like that. That's also why it had such a high equity multiplier, because it relied so little on equity for its financing. So Kellogg, what we find is Kellogg's trying to get more aggressive in how it repays its debt in the coming years. So we'd expect it to be, a little bit more timely with meeting debt obligations. But at the same time, it still does have, a penchant for relying on debt as opposed to equity to take out, like a major, purchases, things like that. So in the coming years, if Kellogg decided to say, if there was some market fluctuation and Kellogg wanted to respond to it with maybe a major acquisition or something like that, we could, we could see an unforeseen, increase in debt just for that reason, things like that.
Would based on their current balance sheet structure, would they be able to finance another acquisition with more debt? Would they be able to take on more debt?
Given the strength in their cash flow generation, and we're projecting that they're going to be able to produce a pretty substantial amount of cash flow regardless of the increase in debt. Again, with the use of the interest rate swaps, we're confident that they'll be able to produce enough cash flow to not only make those interest payments but also pay down that debt. And I think that's really demonstrated by the Pringles acquisition, where they took out about $2 billion in debt for that. They paid off half of that very quickly. They will be getting a little more aggressive with paying down that long-term debt. But with the Project K, they will be taking out an additional $500 million in long-term debt. But given their history of paying that down quickly and their ability to generate strong cash flow, we're confident that they're going to get that paid down quickly.
Okay, what was the purpose of the interest rate swaps then?
The purpose of the interest rate swaps was to reduce their effective interest rate owed on the debt itself. So basically, when you're taking out debt, obviously you've got to repay that interest. But per their most recent 10Q filings, they were disclosing the reasons why they were doing the practice, because they were engaging in the practice because when they did that, they were reducing the effective amount of interest they would have to pay back as a portion of the debt. So reduce the amount of interest they would owe.
On your weightings and when you're calculating your target price, can you go over the rationale again of why you're 20% on relative valuation, 20% on the DDM, and 50% on the discount cash flow model?
We wanted to place a heavier emphasis on the intrinsic valuation with the DCF, as we thought it not only provided a more stable growth rate, but it's considering that Kellogg's investors are primarily comprised of funds and institutional investors, about 80% institutional, 20% individuals. We wanted to, and their preference is generally geared towards the intrinsic side and then also the multipliers, but we also wanted to take into account the dividend payout because of the individual investors. They're interested primarily more in the income factor of the stock. So we wanted to place the heaviest emphasis with 50% on the DCF, 25% on the multipliers, and then 25% for the DDM, just to kind of provide not only a stable growth rate in that, but also take into account the interests of the minority shareholders.
And their dividend payout ratio is a ratio they can maintain going forward?
In the past 5 to 10 years, they've seen a very stable dividend growth rate, and as we showed, they even through the recessionary years, they've consistently been raising their dividend payout.
With earnings?
Yes.
I don't know if you realize this, but institutions are interested in income as well.
Correct. Right, and we took that into account. We took that into account as well. So that's why, we have a slightly higher than, although the individual investors are 20%, it is slightly higher than 20% for the DDM.
I have a couple of questions for you on your interest rate assumptions for your WACC
Sure.
calculations. In whatever slide it was where you talk about the swaps, U.S. denominated debt is 0.21% and Euro denominated debt is 0.18%, and your assumptions 2.35%. So what am I missing here?
Well, the interest rate swaps, they have been reducing the effective interest owed on the debt. That's why Kellogg's been getting into them. Mike can speak a little bit more on how that pertains to the WACC itself.
Are you assuming you're getting out of the swaps, or?
No, they're maintaining the swaps, because as they're taking on more debt. I believe their most recent 10Q, they showed no indication that they were intending to reduce the interest rate swaps. They seem to be paying off pretty quickly. As their interest rate on USD debt, for example, was 0.18%, or their effective interest. I believe that was down from roughly 0.21% per their 2012 and year of end filing. So they've shown no indication of wanting to ease off on the interest rate swaps. It just generates too much value for the firm.
While they are maintaining the interest rate swaps, they are rotating those out as they retire some of that debt and bring on more debt. So while they are maintaining that focus on reducing that effective interest rate, they are maintaining that position by rotating out those swaps as they, like I said, as they retire and issue new debt.
So how did you come up with the 2.35% or the 2.49?
For the cost of debt?
Yeah.
That was based on, for one, we used the current cost of debt and we adjusted that up in view of the changing interest rate environment. We're expecting that with the effect of the reduction in quantitative easing that we're going to see over the next 5 years, we're going to see an increase in yields. So the 10-year, we're expecting that the 10-year Treasury is going to boost that. So we've adjusted our cost of debt accordingly to account for that changing interest rate environment.
You recommended a hold. What would change to make it a sell? You're saying you get potential for 6% return. Would it be, was there a hurdle you were looking for? Where you would say, I'm going to sell the stock as compared to
Or buy it?
I think that if Kellogg had announced a plan to sell some of their snack products globally, we could see a future source of growth sooner. However, their recent plans have been for factory expansions that won't really take effect until 2015, and they have not announced any future distribution plans.
I have questions on your estimates, your earnings estimates. One, where are you coming up with your growth assumptions on sales? It looks like you got 3% growth for 14 and 15, 2% growth thereafter. Where is that coming from?
Well, that's coming from a combination of inputs.
You can finish answering.
Oh, okay. It's a combination of inputs really that went into that. One, we're using obviously the latest quarterly available data, and at the latest TTM values, we're showing that the revenues were for year-end 2013 should be somewhere between 4 and 5%, and that was largely based on it's down from 2012 primarily because the U.S. cereal category is really struggling. In addition to that, it's mainly what was keeping that up was their sales in emerging markets, which you know what, might have some more on the emerging markets. Essentially the emerging market sales were much stronger than the U.S. and Europe sales. So that's really what was kind of supporting that. But at the same time, the largest segment of their business is U.S. cereal, and the growth is pretty weak there. So they are introducing, obviously through Project K, a lot of promotional and ad spend to try to boost that up, because most of their focus has been on boosting that bottom line through these restructuring efforts. But then we're just not very optimistic on their ability to increase that revenue growth, just judging by what they're doing right now. Over the next 5 years, we're thinking it's going to continue to struggle through, from 2015 on, kind of tapering down to between 2 and 3%, just mainly judging by, their failure to get that top line built up. So,
Okay, thank you.
sure.
Thank you.